Hello SD Bullion YouTube subscribers, my name is James Anderson, and this is our second SD Bullion Gold Silver Market Update. The overall four precious metals spot prices moved slightly up and sideways for this past week. The spot gold price appears to be closing around 1,470 per troy ounce. The spot silver price looks to have ended the week around the psychologically round figure of 17 Fiat Federal Reserve notes per troy ounce. The spot palladium price closed the week at $17.50 per troy ounce, not too far from its recently reached newest nominal record price high. The spot platinum price moved up a few bucks on the week, closing just under 900 Fiat Fed notes per troy ounce. Gold-silver ratio fell by about a half an ounce, still requiring about 86 ounces of silver to acquire 1 ounce of gold bullion. Checking in on the latest news for Not QE4 and ongoing repo overnight bank bailouts, it looks like the Federal Reserve's balance sheet has increased now almost $300 billion in about 2.5 months. At this pace, the Federal Reserve will double its current $4 trillion balance sheet by the end of the year 2022. Rumors are plentiful amongst bank analysts trying to determine which of the current crop of zombie-megabanks might bear Stearns or Lehman Brothers later. Financial Twitter tweet of the week goes to Jason Barak of Wall Street for Main Street's YouTube channel. Jason states, in past crises, 2001 and 2008, repo got up to $300 billion or more per month. Soon, repo madness will be averaging $300 billion per day. We're already at $190 billion per day average, according to the New York Fed, without 28 and 42-day term repos just added. Welcome to dystopia. The Federal Reserve's chairman, many-time multimillionaire Jerome Powell, testified before U.S. Congress this week. Only one congressman, Kenny Marchant, Republican from Texas, had the nerve to ask Mr. Powell about the Federal Reserve's intervention in the repo loan market bailouts beginning this past September 17, 2019. Have a listen to this most important section of their back-and-forth Q&A.
And next question, the disruption in the repo market that took place in September. Anticipated, not anticipated? Do you anticipate keeping the expansion at the level it is until you're sure that won't happen again?
Well, so anticipated or not, it's a different world post-crisis, and really because of all the expansion in our balance sheet and essentially what we've done now is we've now required financial institutions to have a lot more liquidity on their balance sheets so that the Fed doesn't have to run in and with our own liquidity. So that's I think a big benefit to the financial system. But a lot of that liquidity is held in our reserves. We used to manage the interest rate by keeping reserves scarce, and we had a total of $20 billion. Right now we have in excess of $1.5 trillion in reserves, and so that means that we're trying to find that level as we allowed the balance sheet to shrink where reserves would become scarce, and there was really no way to know. I think the data that we had suggested that we were not close to that point until September. I think we're still very much looking at what happened in September, but I think we learned in September that we needed to make sure that reserves didn't go under that level that we were at in mid-September, which is a little bit shy of $1.5 trillion. So that's really what we're doing. It's technical. I think we have it under control. We're prepared to continue to learn and adjust as we do this, but it's a process. I would say it's one that doesn't really have any implications for the economy or for the general public, though.
Okay. Thank you.
If you bought Jerome Powell's explanation, I have a bridge you might be interested in purchasing. More seriously, though, let's hear from respectable, skeptical Wall Street journalists Pam and Russ Martins, who had the following response for Jerome Powell's bumbling, brief explanation. Apparently, they go on to write in response, the new talking points are, it's too technical for the common brain, so move along and leave it to the geniuses at the Federal Reserve. The second talking point is, nothing to see here because it doesn't impact the economy or general public. But of course, this is dangerous propaganda. The Fed is back to creating the same kind of moral hazard that it created when it secretly pumped trillions of dollars into Wall Street trading houses and global foreign banks during the financial crisis, and then waged a multi-year court battle to keep it secret from the American people. The Fed's current money spigots impact the U.S. economy because it further enriches the top 10% who own the vast majority of all stocks and bonds in the U.S. It impacts the economy because it's ballooning the size of the Fed's balance sheet, now back above $4 trillion, which the U.S. taxpayer is ultimately on the hook for. It impacts the U.S. economy because it's worsening the existing bubble that already exists in the stock market, thus making the inevitable bursting of that bubble worse. And it impacts the U.S. economy because this big propaganda lie further undermines the trust the American people have in the Federal Reserve and the U.S. banking system. Pam and Russ Martins also note for their readership that since September 17, 2019, the Federal Reserve's been pumping hundreds of billions of dollars each week that the New York Federal Reserve Branch creates electronically out of thin air into its 24 primary dealers on Wall Street. These primary dealers are not commercial banks that might be inclined to use the funds to make loans to local businesses or to consumers to buy a house and help their local economies. Now, 23 of the 24 primary dealers are stock brokerage firms and investment banks that engage in leveraged bets in the stock, bond, commodities, and derivatives markets. 24th is a foreign bank. I'll leave a link to that excellent article in the show notes for you to track down and read, but be careful, some of their points may raise your blood pressure as they did mine. Moving on to our final charts of the week, Nick Lyard, the owner of goldchartsrs.com, emailed over some trend charts. Major fiat currency holders should consider the overall 21st century trajectory for central bank fiat currency purchasing power losses to come. This first chart shows how much purchasing power 9 major fiat currencies have respectively lost to gold bullion in the 21st century thus far. You're looking at fiat US dollars, fiat Australian dollars, fiat British pounds, fiat Canadian dollars, fiat Chinese yuan, fiat euros, fiat Indian rupee, fiat Japanese yen, fiat South African rand, and fiat Swiss franc. Ask yourself, is this overall trend going to revert in the next decade or two? Here's how silver looks. Note the 2009 to 2011 stretch where silver vastly outperformed even record price setting gold. When might we see another replay of that performance again? That's all for this week. If you like this show and this weekly show, be sure to subscribe and click the alert button so you don't miss it. Oh, and by all means, like the video, comment below, and let us know what you think. Have a great weekend, everyone.